Should you invest in stock market? Should you invest in mutual fund? Or should you invest in gold, real estate, PPF, FD, etc.? How to balance the allocation between equity and debt? What is the right strategy to invest money? Should you invest when the markets are at all-time high, or should you wait for the fall? This is the biggest dilemma of every investor in the country. Well, honestly speaking, investment is not a science. So there is no fixed formula. But investing is more of an art that requires a good strategy to balance the investment. On one side, a right strategy can help you create wealth. On another side, a wrong strategy can result in losses. Hello everyone, my name is Sahil and this is my Personal Finance Academy where I explain everything about money management in layman's language. Welcome to another episode of Let's Learn Investment. There is a famous saying that when it comes to investment, do not keep all your eggs in a single basket. Basically, it means you should diversify your investment. But many people find it difficult to make the right mix of investment for diversification. So I want to share my investment strategy and that would give you a good understanding of diversification. But before I share my strategy, I want to share the results of the poll that I conducted. So I asked you folks about your preferred option of investment between stock and mutual fund. I got an overwhelming response of almost 10,000 people while I am recording this video. Thank you so much for replying in such huge numbers. Here is the survey breakup. 29% people said that they invest only in stock. 5% said that they invest only in mutual fund. And 64% people said that they invest in both stock and mutual fund. So clearly, majority of people invest in both stock and mutual fund. I also asked, apart from equity, that is stock and equity based mutual fund, where do you invest your money? I got around 6,500 responses and here's the breakup. 14% said that they invest in debt mutual fund. 13% people invest in FD. 22% people invest in real estate. 20% in gold. And 32% invest in a mix of all these options including FD, gold, real estate, etc. Clearly again, people like to diversify their investment. When I started my investment journey, I also had all these doubts about the right strategy to invest my money. Over the past few years, I have done an extensive research to understand the right strategy to balance my portfolio. I have divided this video in two parts. In first part, I have shared my strategy and in second part, I have also shared my portfolio returns. But before we proceed, I want to clarify that I am a long-term grow well investor. I have coined this term myself as it is a combination of growth plus value investing. What exactly is growth investing and value investing? We will discuss it in a separate video. I also don't do day trading. It is because I believe that trading is a full-time profession. You can't do your job or business and do trading in parallel. Of course you can do it, but you can't consistently create wealth with part-time trading. In 5 trading sessions of the week, even if you make money in 4 trading sessions, it just takes one bad session to wipe out all your profits. So I stay away from it. I also don't do F&O as I feel it is too risky. I also don't invest in penny stock as I believe in investing in fundamentally strong company and I'm happy with my decent return with those good stock. I have also created a video on my list of top 100 plus stock that I track for my personal investment and you can access it on my website. I might have missed a few good stock in the list, but I ensure that I don't include the bad ones. I also don't invest in gold. Although I feel that 5% can be kept in gold, but currently the price looks overvalued, so I haven't invested in gold. And when I say gold, I mean digital gold. Physical gold is a big no. It is mainly due to high making charges in physical gold. I don't invest in FD as the rates are way too low and after tax return are even below the inflation rate. I prefer to invest in debt mutual fund. But you can always consider FD as an alternative to debt funds. I also don't have a lot of money to invest in real estate. In future, if I earn more, I would like to have some exposure in real estate. Folks, I want you to watch this video till the end because at the end, I will tell you my plans on topic that I intend to cover in the future. Alright, now let me share my investment strategy. First of all, I have divided my investment amount in 2 parts. Equity and debt. I periodically review my portfolio to decide the right allocation strategy of money within equity and debt. I've already created a video on right strategy to balance the portfolio between equity and debt. For example, in current situation, I've kept an allocation of 50-50 in equity and debt. Now within equity, I have divided my investment in stock and equity mutual fund. You can say 50-50 in both. Within stock, I have two portfolios. One is core portfolio and another is satellite portfolio. Core portfolios have the best of best stock that I do not intend to sell. Maybe I will pass on this to the next generation. Having said this, I keep an eye on them to avoid a Yes Bank like situation. It includes companies like HDFC Bank. Next is the satellite portfolio, which is more of a swing trading where I identify the hot sectors and keep investment based on the latest trends. For example, IT, pharma and chemical are the hot sectors currently. Overall, I try to keep 50-50 in both core and satellite portfolio. In terms of market cap, I like to keep 50 to 60% in large cap and rest in mid and small cap stocks. Now within equity mutual fund, I have two subcategories, active fund and passive fund. Active funds are the funds managed actively by mutual fund houses. I prefer to have mutual fund with multi-cap allocation across large, mid and small cap. This gives me a good balance of stability and growth. I also like to keep US based fund in the portfolio. Within passive funds, I like to have equal exposure of Nifty 50 and Nifty Next 50 based index fund. It can also include ETFs. I strongly believe that the future of mutual fund is index fund. With very low cost and as Indian market matures, it would be very difficult for active funds to beat the passive fund. Currently, I keep both. Next category is debt. Now this is a very tricky category. It is because it is difficult to track the bond market. If you keep a track of market, you would know the Franklin Templeton fiasco in the past. However, if you know how to select the right debt fund, you will never face any problem. In fact, it is better than FD in terms of return and tax saving. But only if you know how to select the right debt mutual fund. You have got many categories in debt fund. For example, you have liquid fund, money market fund, ultra short term fund, short duration fund, medium duration fund, long duration fund, gilt fund, banking and PSU debt fund, corporate bond fund, etc. Each category has different risk versus return potential. I prefer to invest in low risk debt mutual fund as for high risk, I already have equities. Within low risk, I prefer to keep some money in liquid fund for emergency purpose. Apart from this, I like to keep money in banking and PSU debt fund, money market fund and corporate bond fund. However, I am very careful with my debt fund selection and I check the risk profile of each debt mutual fund as well as the portfolio to ensure that the debt mutual fund invests in good quality bonds. So this is my overall strategy. If I summarize, first breakup is between equity and debt. Then within equity, it includes stock and mutual fund. Within stock, it includes the core portfolio and satellite portfolio. Within equity mutual fund, it includes active and passive mutual fund. And finally, within debt mutual fund, it includes liquid fund, banking and PSU fund, money market fund, etc. Alright, now my portfolio return part. So I will only show the mutual fund portfolio return as the stock returns are more dynamic as I keep buying and selling stock from the satellite portfolio. So it won't show the right picture. Friends, before I share my mutual fund portfolio, I want to make few things very clear. The returns you would see are total return. It is not a CAGR return. I have invested most of my money in last couple of years. Some of the money is invested via lump sum and some via SIP. So it is a mix of lump sum investment and SIP. Okay, so first of all, my mutual fund portfolio is divided into equity and debt. Equity has currently 39.5% allocation, debt has 41.8% and liquid fund, which is also a type of debt fund, has 18.7% allocation. Now within equity, I have invested my money with Axis and Mirae Mutual Fund as these two fund houses are consistent top performers. Again, I would repeat, there are many good fund houses. In Axis Mutual Fund, my returns are 63.3% and Mirae returns are 54.1%. Friends, I don't want to show my exact investment amount, but it is a significant amount. Again, I have invested at different times in different funds. So you can't say that Axis fund is better than Mire only on the basis of total return. Now within Axis mutual fund, I have Axis growth opportunity, which also include exposure in US fund, and it is giving me 47.5% return. Next is Axis long-term equity fund, which is an ELSS fund and help me in tax saving. It is giving me 74.1% return. Next is Axis small cap giving 25.7% return. Then I have Axis Flexi Cap with 50.9% return. Finally, Axis Nifty 100 Index Fund with 52.6% return. So you can always have Nifty 50 and Nifty Next 50 Index Fund separate or ETFs. Within Mire, I have Mire Asset Focused Fund with 89.3% return. Mire Asset Emerging Blue Chip Fund with 49.2% return and Mire Asset Tax Saver with 51.1% return. Now let us look at the debt mutual fund category. Within liquid fund, I have invested in Axis Liquid Fund and Mire Cash Management Fund. Axis Liquid Fund is giving me 4.8% return and Mire Liquid Fund is giving me 2.9% return. Please note that I have recently increased the exposure in debt fund a few months ago. Hence, the returns are on lower side. Now within Axis, I have invested in Axis Money Market Fund, which is giving me 3% return. Then I have Axis Banking and PSU Debt Fund with 1.8% return. Within Mire, I have Banking and PSU Debt Fund with 1.7% return. So this is my overall portfolio. Equity mutual fund are giving 60.7% return, liquid fund are giving 3.7% return and debt mutual fund are giving 2.4% return as of 22nd February 2021. Please note that these are not the only mutual fund to invest. There are many good mutual funds available as per your risk profile. I review my portfolio periodically and rebalance it accordingly. Friends, it is not that my returns have always been so high. There was a time when returns were 5%. There was a time when returns were 10%. In fact, the returns plunged during the March crash. Many people lose hope when they don't see good return in their portfolios. I remember people cursing mutual fund till last year due to poor return. And that's where patience and disciplined investment help. I knew that if I stay invested for a long duration, mutual fund would give me good return. So patience and discipline is the key. Give me a few more years and the return will be more than 100%. That's my confidence in the Indian economy and my investment skill and knowledge. In the short term, it can even fall if there is a correction, but I will utilize that opportunity to invest more. In fact, that's what I did during the March 20 crash due to COVID. I invested more. I know that it is not easy to invest when the market is falling, but that is the best time to invest for the long term. You need a lot of conviction on your knowledge and trust in the Indian economy. Most of the people make the mistake of entering when the markets are at all-time high. That is due to greed. And when markets fall, they become fearful and exit at loss. Whereas you need to be greedy when everyone is fearful and be fearful when everyone is greedy. I hope you will find this video helpful and these numbers would motivate you to invest in mutual fund along with stock. Having said this, please invest your money systematically. Do not try to time the market. And above all, learn before you invest your money. Friends, when it comes to investment, there is no one-size-fits-all strategy. Some like to take high risk, some like to take low risk. I like to make a fine balance between the both. Moreover, the investment are always linked with financial goals. You can't randomly invest. You should have tentative goals in mind and that would give you the right clarity on your investment. For example, if you are a young person with a goal to retire in the next 20 years, then you can have higher exposure in equities. If you are someone who is going to retire in the next few years or have already retired, then you should have higher allocation in debt or safer instruments. Likewise, it would vary from person to person based on risk appetite and financial goal. If you are someone who has no idea about stock investment, no knowledge and no time to do research, but believe in India's growth potential for the next 10, 20, 30 years, then simply invest periodically in Nifty 50 and Nifty Next 50 Index Fund or ETFs without worrying about the ups and lows. This would give you a good return in the long term and above all, it will give you a peace of mind. However, if you are someone who likes to track the market and investment, then you can always consider a mix of mutual fund and stock market. I am doing a lot of research to identify the great companies for you in the stock market. Friends, at the end of the day, the goal should be to achieve financial freedom. Stock market investment is just one aspect of it. It also includes various other ways to increase income, ways to reduce expenses, various other options of investment and risk management with insurance, tax planning, etc. I have achieved my financial freedom at the age of 31. I hope you guys will also achieve it soon. I'll probably make a separate video on my framework to achieve financial freedom. If you are thinking, how did I gain this knowledge? Then I can say that I'm a huge follower of Mr. Warren Buffett. I do what he suggests. That is, I invest my time and energy in gaining knowledge. I spend hours reading and gaining knowledge, and I think a lot. And I want to pass on this knowledge to you all. As they say that knowledge multiplies with sharing. I have also curated a complete course on everything about money management where I have explained every concept of stock, mutual fund, insurance, tax planning, etc. And it is all in a structured manner. It is already helping a lot of people as investment in knowledge will pay you the best interest. Friends, I can go on and on about Warren Buffett and his learning. But for now, I just want to share one of his message. So Warren Buffett and Jeff Bezos met one day. Jeff Bezos was a big admirer of Warren Buffett. He asked him, Warren, your investment thesis is so simple and yet so brilliant. Why doesn't everyone just copy you? Do you know what was his reply? He said, because nobody wants to get rich slow. Let me repeat in bold letters, nobody wants to get rich slow. And this is the harsh reality. Everybody wants to get rich very quickly these days. However, success in equity market is built slowly. You have to be patient. Real investing is boring. Not many people possess patience and discipline. So if you want to make money in stock market, you need to have patience and discipline. On this note, we will end this video. In the future, I will cover many topics like good debt mutual funds, learning from Warren Buffett, how to achieve financial freedom, and many more topics like review of other financial products including NPS, PPF, insurance, etc. And I will also help you understand each product in layman's language. So stock market is just one aspect. I intend to cover every aspect of money management, which is a holistic picture. I wish to help you folks in your financial journey so that you can also achieve financial freedom at an early age. Take care.